Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for August 25th of 2024. We have a bit of interesting charts this week. We're going to start off with this one. This is kind of getting caught up on the AI theme. You can see a lot of different themes on this chart. So this is just basically the S&P 500 equal weight versus the market cap weighted index, which is the one that's reported in the financial press. We've been talking about this a lot. There's been a large valuation gap between those two, and obviously the AI related stocks, artificial intelligence, have been really catching the bid over the last year or so. And what that's doing, because the S&P 500 is a different index than what it was 10 years ago, and it's heavily dominated by these very large tech companies. And so that has caused the market cap weighted index to greatly outperform the rest of the market. And you can see that very clearly defined here. In fact, we have eclipsed one standard deviation, which in mathematical terms is a rather significant development. You can see here that doesn't happen very often. It happened back in the tech bubble, which you can see there, COVID, and now AI. And usually this does mean revert. And so, statistically, that's why you have these standard deviations, because 2/3 of all observations on annual performance numbers are going to be in between these two red lines. And so you expect that is going to go away over time. Here we have earnings expectations for AI stocks. That is in the red there. And just like all things that are cyclical, so are the earnings of these large companies. And frankly, when you get to be a large technology company, or a large company of any ilk, you're running into the law of large numbers. And what that means is that it gets harder and harder to have these percentage gains in earnings. And that's exactly what's happening with these AI firms right now. As you can see, the rest of the S&P 500 is in this slow, methodical uptrend, maybe a slight downtick as of late, but clearly AI stocks have, I think, for the time being, kind of played their hand as far as their earnings growth, and we've seen price action that's been even well above the earnings growth, which means that the price to earnings multiple has greatly expanded for these, which in many respects has created a bit of a bubble. And so I think that sets the stage for potential increased volatility overall in the market. But as you can see here, there's more volatility in the earnings and potentially in the price of these AI stocks relative to the rest of the market. In that blue line, which has a much more methodical growth track to it, and I think will help to underpin valuations here heading into the end of the year. We have household allocations. This is catching a lot of press lately in lots of different publications. This is from B of A. You can see that household allocations of stocks are basically pretty close to record highs. And when you go back to the you got to go back to the dot-com bubble to see levels even close to where we are now, and back in the global financial crisis. It is important to note that those allocations were a lot lower, but I do think, and this is reported in Rich Bernstein's research, reported in B of A research, it really is, I think we really are on the precipice of a large capital spending cycle because of onshoring, because of deglobalization, and there's going to be a lot of capacity that's going to need to be developed here in the U.S. to accommodate that deglobalization. And I think that households that have investments in cyclical businesses are going to be very well positioned for that. And as you can see here, there are a lot more households that are invested in the market, period. Here we have container rates versus import prices. So we talk about this whole inflation thing, and last month we actually had an outright decline in producer prices, which I think we all celebrate, but these things do not always move in a linear fashion. And this is something that kind of reminds us that we do have exogenous forces that influence inflation from time to time. And of course, we've got container freight prices that seem to be moving a little bit higher again. And what is the implication on import prices, which feed into productive prices? Again, this goes a little to our onshoring theme, that you're trying to deglobalize, and so you become less beholden over time to things like container ships, but container freight rates. But still, these are things that we need to monitor. Inflation's not going to go, back to where it was relatively soon. Overall inflation is going down, but there are pockets of higher prices that we need to be cognizant of. You have corporate revenues, and obviously, revenues are the mother's milk for earnings, and you can't have earnings without revenue growth. And it looks like revenue growth is kind of holding in line as we get our little pen out here, and we can kind of see that this is a zero line. That's the solid line, but you can see overall we're looking fairly good at this juncture relative to the historical backdrop in terms of overall corporate revenue growth. Quick comment on labor, and we've talked a lot about the kind of the recent slowness in pockets of the labor market, and we see continuing claims moving a little bit higher, new jobless claims moving a little bit higher, unemployment beginning to perk up a little bit, which is all very well and normal when you have a cyclical economy, especially when you've had tight credit as we've had. But good news here is that layoffs implied by WARN notice filings, and this is a federal legislation which requires larger companies, or at least not necessarily larger companies, but larger layoffs that have to be reported to the federal government. And you can see, where we are now is not terribly exciting in terms of its volatility. Perhaps, we've had, in fact, it's very flat. And this is kind of what I've been saying for the last month or so, and the data that's come out is like, we see softness in hiring intentions, but we really don't see a lot of layoffs right now. And if you go back, this data series goes back to 1999, and even if you cut it off post global financial crisis, we're very much in line with that. So to kind of put a bow on it, what we're seeing right now is hiring intentions being very muted right now, but layoff announcements are very low. Some quick comments related to economy and recession. We've been talking a lot about this over the last couple of months. There's a lot of data that's supporting a little bit of slowness in the economy, but there's a strong feeling that we're going to get a soft landing. Obviously, a strong feeling that we're going to get rate cuts beginning here next month. And you can see here that the discussion of recessions by management teams in earnings reports, et cetera, conferences, presentations, things like that, is really gone down. We're down at 5% here, and you can see obviously it's been been a lot higher recently, and we've had some of these peaks, and obviously coming down out of the global financial crisis, there was a lot of discussion of recession back then. Right now, not so much. Very muted, almost a complacency factor that's kind of set in here with regard to the perceived risk of recession. Now, coming over here to the right, we actually have recession probability, and this is J.P. Morgan's work with data from the Bureau of Economic Analysis, BEA. And you can see here that you've got declining recession probabilities. And at the same time that you have real goods consumer spending, which is moving higher, which is what you want to see if you are expecting to head into a new economic cycle. And it's doubly important because the consumer represents 2/3 to 70% of the overall economy. Well, with all discussions on the consumer, we have to realize that there are puts and takes to all of it. So in the S&P 500 here, we've got this in the blue line, and we do have uh, we have had some downward revisions in overall sales figures. You can see the breakdown by sector. So when you talk about household, personal products, food and beverage, these are consumer-facing companies by this title have disproportionately downgraded their sales expectations. On the flip side, you've got telecom, and you've got healthcare, you've got technology that are moving higher, and so the net of all of that is putting S&P 500 slightly lower. But we really haven't seen that kind of channel necessarily into earnings expectations because people feel like margins are going to hold up and be a little bit better. We talked about that in the last week's bundle of charts. And then over here we've got consumer discretionary sales, the change year over year. Even though that change year over year is in decline, it's still kind of roughly 4%, which is extremely healthy if you kind of consider going back to the beginning of this century, that falls very much in line with this, with the preponderance of these data points. So consumer, again, is perhaps a little more constrained, if you will, and maybe decelerating, but they're still spending. And even though you've had some increased caution on the part of the consumer-facing sectors with regard to perceived future prospects, it still is overall net healthy. We have savings rates, and we've got some kind of demographic data or income cohort data, but you can see the impact of housing on the household net worth index. We've got disposable income, which is not trailing household net worth, but you do have that spending that we've been talking about, and as a result, savings rates have gone down. And this, if you go back to here's our pandemic and the shutdown and all of the noise surrounding that, but you can see savings rates have come down on average since then. Disposable income has moved higher because we know that real wages have gone up. Wages have moved higher net of inflation. And we also know that housing values have gone up. So household wealth index, which is inclusive of a housing related assets, stock market related assets, so on and so forth. So it's an interesting time in our nation's economy with regard to spending and saving and the wherewithal to sustain that. Well, keeping in tune, we've got kind of income quartiles that we can report on here. This is a cumulative national savings on the left-hand side. And we look at the bottom 20% of income earners as well as the top 20%. And what's very apparent in this is that you have cumulative national savings, which is really embedded in that top 20%. You've had net savings declines in these lower income cohorts because they essentially have been spending beyond their means. And so they've been eroding savings at the same time. Here's the marginal savings rate. Between these various groups, and you can see that these are negative over here. So essentially the bottom 40%, they've been driving a lot of consumption, but they've been funding it out of whatever savings they have. Whereas, the top income earners are continuing to save at a reasonable clip, and they have a lot of money in the bank. What this does is it creates basically, spending power that's becoming increasingly unequal. And then if you look at, consumption versus income over here, you can see that, percent of national consumption amongst the bottom 20% is 9%, but they only account for 4% of national income. So it goes right back to this chart, which shows you that they're spending out of savings. And as you go up the income quartiles, you can see where those ratios change dramatically, and where you're essentially spending less than you're consuming, and so that leads to increased savings. So that's where we are as a country. We'll obviously want to continue to monitor this because it really is kind of that bottom, 60 to 80% that really drives a lot of consumption in this country. We have real incomes, which we were talking about a little bit earlier. So we know that real wages have gone up at a clip exceeding inflation as inflation has come down. And you can see that real incomes are actually increasing for all cohorts. So this is a good sign. Inflation is apt to continue to come down. And we do think that perhaps real income may decelerate. Overall, we're looking at 2.4% on a year-over-year basis, which is good and healthy. We want to see that continue on a real sense, i.e. net of inflation, to continue to move positively higher. That will help to sustain consumption to some degree as we look into 25 and ultimately into 2026. Here we have sentiment around the consumer, and so people are generally feeling a little bit better. This number trends above 50. That means that there's a greater share of these pundits and these conversations about the health of the consumer. Generally speaking, the majority of those conversations are positive and have been for about the last year or so. And again, they were much better after the pandemic shutdown and then the reopening, and then everyone got checks and everyone felt good about the consumer. They were buying stuff on Amazon, and then then we had kind of a mean reversion here, and then now the sentiment again is once again positive with regard to the consumer. Here we have some delinquency numbers. We continue to monitor credit. Again, not overly alarming, but I will say that this has caught my attention. We've got prime auto loans as well as subprime loans that we've seen notable recent spikes in delinquencies. So something that we definitely want to pay attention to. You think about homes and autos being the priorities for a lot of consumers. You can't lose your home. You certainly can't lose your car. Mobility is very important. So the fact that we're seeing these spikes on items that tend to be more prioritized by consumers is something that we definitely want to keep our eyes on. Here we have company guidance on capital spending. This is also really good for the economy. When you think about the drivers of the economy, what's the equation for economic growth? And it's really consumption, both personal and business. You've got net investment, which is what we're talking about here, and then you have government spending and then net trade. And so on that investment side, it's really important that companies feel incentivized to invest in new capital equipment or capacity expansions and things like that. And so when you look at this chart, you've got in this dark blue, you've got non-residential fixed investment. That's going to be, that has been positive and likely to continue to be positive. You have S&P 500 capital expenditures that have decelerated, and something that we've definitely taken note of. But the current estimates have that at like around 4%. So perhaps not as robust as it has been at junctures in the past, but it's still positive and still very additive to overall economic growth. We talked about labor a little bit before, and so you've got the share of management teams discussing labor shortages, and that's gone down quite a bit. So this is, kind of dovetails with the layoff announcements and the harm notices. We really haven't seen a spike in layoff announcements. We do see hiring intentions be relatively muted. I think that's companies just being cautious and you see a deceleration in the intensity at which labor costs are troubling management. So that's not as bad as it has been. At the same time, teams really aren't saying that they're short labor. Now, this is not necessarily good for an expanding labor economy, but it's very symptomatic of really what we expected with tight credit is that you're going to have a natural slowdown in labor. And I think, this type of setup here on both of these charts is helpful to the Fed in its dual mandate of, price stability and also full employment. That you really kind of have that. If people aren't worried about having to go hire people, they feel like they're adequately staffed and they're not as worried about labor cost inflation as they were. That's actually a pretty good setup for the soft landing, and it gives the Fed a lot of cover to lower interest rates. This slide, we got a little bit of a recent data point from the S&P Global Manufacturing PMI and Services PMI, and it's a tale of two cities as we have been monitoring for quite some time. Again, this is global, not just the U.S. We do see manufacturing still trying to get above the break even. We did that for several months, and we've had a little bit of deceleration overall overseas. Again, this does also include the U.S., but it's just global. Now, on the flip side, services PMI remains solidly in expansion territory. This is a diffusion index, so everything below this midline here, the 50 line, represents contraction. Everything above it represents expansion. So, we're still waiting for manufacturing on a very global sense to kind of get its footing a little bit. But, there is hope. We do see potentially some increases on the horizon for capital spending as businesses across the globe get a little bit more optimistic on things. So now with the S&P Global information as a backdrop, we can talk about earnings per share. This is looking at global earnings per share growth. This is here in the dark blue line. We have the EPS growth on a 12-month year-over-year basis looking ahead. This is forward earnings. You can see kind of amidst this light blue line, you can see that number is now around 11%. So we've had some acceleration here as of late in global earnings, obviously driven a little bit more by the services sector overseas. And then, you've got other investment bank firms like B of A and their global EPS model that looks like it's rolling over. So, you're hearing from some people they expect that earnings are going to roll over a little bit, but still remain positive. Even if we saw 5% on a year-over-year basis, looking into December 24, that would certainly represent a deceleration from the numbers that we're looking at right now, but it's still positive overall in terms of the global backdrop. Getting back to the U.S. investment market, here's the AAI bull bear spread, which just means that you have more bulls than bears, and that's why this number is positive. This just means that the individual investor is quite bullish at this point. We did have a little bit of a shock when we had that sell-off a couple weeks ago, but we've largely rebounded from that. And these are fairly frequent surveys, and so you can see that the preponderance of observations that are incredibly positive here for the balance of 2024. The individual investors have felt quite strong about investment prospects. We've certainly talked a lot about real rates being fairly restrictive, and the Fed perhaps being a little bit behind the curve. That was some of the frustration in the market a couple weeks ago when we have seen announcements from other central banks lowering rates, and there was this growing sense that the Fed was behind the curve. And this is one reason why. So this is basically taking the Fed funds rate and subtracting out core consumer price inflation. And you can see that number has moved increasingly higher as we've come out of essentially, 2022, and that number is really high. So we're about, 2.2%. on that delta. And you've got to go back to the first decade in this new century here to find numbers where we're at right now. And so this really is quite restrictive when you get down to it. So real rates being positive is something that is not is not a bad thing, but having real rates that are moving higher concurrently when inflation is moving concurrent to inflation moving down is something that sets up a pretty restrictive environment. And with that, you have sentiment that agrees with the data here that says that fund manager surveys, the most recent one by B of A Global Research, monetary policy is very restrictive, and I would certainly agree with that. That last chart showed you that sequential increase in the relative level of tightness in the credit markets. Would obviously lead you as a fund manager to believe that conditions are too restrictive right now, and I certainly agree with that assessment. And kind of dovetailing a little bit more from that, you can see that the Fed funds effective rate here is about 5.3%, with a target of 5.25% to 5.5%, and then the market is now pricing. And this is year in 2024. And again, I will tell you that oftentimes the market gets ahead of itself a little bit. And we've already seen some notable examples of that over the last couple of years with the market, even entering this year. The expectation for 7, 6 to 8 rate cuts this year was completely unfounded. And right now we're looking at 100 basis points or more of expected rate cuts by the end of the year. And, I'm not sure that we're going to get there. The big question right now is not necessarily if the Fed is going to cut rates in September, because Fed Chairman Powell at Jackson Hole this past week said the time is right to begin policy, to taking off policy restrictions, i.e., cutting rates. So he's basically saying that this is going to happen in September. The question is it going to be a quarter point? Is it going to be a half point? And then do you follow that up in the next meeting, like when you're literally right on top of a presidential election? And, these are open questions, but, we've seen in just really a matter of months how this has really gone the other way from where we were at the end of last year. And so, 100 basis points is a full percentage point. I'm not sure that we get there, but I do see the easing on the horizon, which I do think will help grease the wheels for the investment markets. We'll talk a little bit about housing. We always try to keep our finger on the pulse because there's so much second derivative spending that happens with housing, and we do in fact have some read-throughs on this. This is important for the consumer. We don't see a lot of housing mobility right now. The housing market's a bit of a funk. 30-year fixed mortgage rates are about 6.5%. They're off their peak of close to 8%, which is good. Home prices are still relatively high, and we have seen with those rates moving down a little bit of a jump in refinancings, but overall mortgage activity has been very, very lame. And you can see university admission buying conditions near interim record lows. We have Realtor.com, and this is something that I've been talking about a lot, even though you don't see it yet in the core consumer price index. Rents in both its real and observed form, which is what this is, and the calculated owner's equivalent rent that you see embedded in the inflation reports. But you see on a year-over-year basis that you're actually witnessing negative rent growth. And so I do think it just is a matter of time before that manifests into the inflation numbers. Rents have been sticky. And again, just to reiterate something you've heard me say 1,000 times, that the stickiest components of inflation are rents and wages. We do know that wages are migrating lower. we do see that rents are negative right now, even though they're perhaps a little less negative than they were, earlier this year, but they are negative on a year-over-year basis, and I think that's very important to the overall inflation picture as we look ahead into 2025. An interesting data point. I'm not sure I would have expected this, but what's interesting, and unless you look at it on a frequent basis, you wouldn't know that Home Depot's same-store sales have been negative for the last 7 quarters. And so home improvement spending has really almost kind of fallen into the same general bucket as home buying conditions, that people are not spending to improve their homes, which is an important second derivative spending category, for the economy. Median size of new single-family homes. We've talked about this in my role as an elected official here locally, that this happens during economic cycles. And you can see very clearly that, when you get into, here's your global financial crisis, but when you emerge into a very strong new market cycle, your pricing power improves, and you get to a point where people can afford larger homes. And then over time, that just changes. And right now, what's interesting is we've gone from about 2.5 or 2,500 square feet average down to about 2,100 square feet, which in percentage terms is a pretty meaningful change. And so you're just seeing, and because price points are moving higher and have accelerated really since the pandemic, and you can see that deceleration in home size, home footprint, I guess, in terms of square feet, is moving at a faster pace to get down to the current 2,100 square feet. Yeah, I have a lot of data here. This is kind of like oil on a slide. And so you've got crude oil stocks, which are at their lows, and the gray areas represent kind of the 5-year range. And you can tell that we're very low relative to our 5-year range on oil stocks. Gasoline stocks are at the lower half of their 5-year range, and you get to distillates also at their 5-year range. And what we've seen here lately, this is Brent crude prices. We're about $76 a barrel. You can see that has largely gone down over the last several months, and we're back down to levels that we were at really towards the end of the year. And so some of that is a byproduct of crude oil production, which, as you can see here, we're just under 13.5 million barrels a day. And you can see how that's gone up over a number of years. And I think this is the story that we're going to have to paint. I showed you a chart a couple weeks ago that, looking at gasoline stocks and where they were, and even though they're low, we've had a lot of production and we're exiting the peak driving season. So we should expect gasoline prices to move lower here in the next month or so. Here we have, getting back to the investment markets, we've got in this purple shaded bars, we've got the Magnificent Seven total returns. Now, these are not earnings, but these are total returns. And then the black bars represent the S&P 500 market cap weighted index. And for the first time in a long time, we have actually had underperformance in total return from the Magnificent Seven after quarter upon quarter of outperformance. And even when stocks were negative in the third quarter of 2023, you still saw that the Magnificent Seven stocks were down less than the rest of the market. But for the first time now that we've seen underperformance from the Magnificent Seven or the Exceptional Eight or whatever you want to call it, and as you saw in that chart earlier in the presentation, that we've seen that crest, we've seen that top in earnings growth for those Magnificent Seven stocks that are tied to artificial intelligence, and now we're seeing those earnings estimate fall. What this tells me is that the rest of the market is going to matter a lot more looking ahead, And if we are hitting an economic, or we're hitting a soft landing and we're migrating very slowly into a new capital spending cycle, that there's a lot of stocks in that quote unquote rest of the market that should do relatively well. And if this is habit forming, then we're going to see a definite change in market leadership in the quarters ahead. And here we have the last slide of the day. We talk a lot about alternative investments. We talk a lot about diversification into areas of the investment world that have different return characteristics from the stock market. And we call that diversification, because what we're trying to do is we're trying to manage risk. Well, one of those areas is private credit as well as private equity, which you've all heard of. But private credit is an area of alternative investments. It really has taken off like a rocket. And this is kind of like the non-bank sector. There are a lot of companies that would prefer to go to, private firms that have raised pools of money to get financing. Then they prefer to do that than to go to their commercial bank to do it. And so we also call that disintermediation to some sense. But one thing that we have to follow is the credit quality. So obviously there's a lot of money that's been committed to these areas. And so, you have to follow the money and try to understand where the risks are. And the primary risk, of course, with private credit would be defaults. And as you can see here, default rates on a chart that is probably a little noisy, but it just breaks it down into different quarters. And here's the first quarter of 2024. These default rates are not incredibly high. Certainly not relative to the conventional banking market, but as we see here, these are not overtly significant. And whether or not you're looking at smaller transactions, less than 25 million, or that middle market, which is 25 to 50, or even the over $50 million. These deals are just not defaulting at a rate that is going to get your attention and cause you to wonder about the whole integrity of the credit cycle. That's all we have today. Hope you've enjoyed the presentation. Have a great week, and we'll talk to you again during Labor Day weekend. Take care.